Hey, welcome to NAAIM Confidential, episode 38. I'm this week's host, Ryan Redfern. Today we have Chuck Falco, who has a whole ton of designations. I think I counted 11 of them. We'll talk about that in a minute. Great to have him here today. Somebody who also does financial planning and marries that with active management. I think that's an awesome thing, and it certainly has been a recurring theme on this podcast. So great to have Chuck here today. Let's start off with the NAAIM Exposure Index. I don't believe he is a contributor, so I'll just show you really quickly. We are at 86.93. I know personally, I reported 0, so I'm kind of fascinated that everybody stayed in the market and I was backing out. So I guess we'll have to see how that plays out. Maybe we'll get Chuck to contribute to this in the future, but I know currently he is not. So there you go.
We could do that.
You should absolutely. All right. Well, let's start with you, Chuck. You got to tell me about all these designations, what some of them are, and some highlights, and what made you do that many.
Well, I originally came from the broker dealer side, and when I was in college, I graduated from Temple, and I was in Temple, had an accelerated master's program. And what happens is you go there for 6 years, or instead of doing it in 6 years, you do it in 5 years if you take special classes. I had 2 classes left and I couldn't take it anymore. And I said, I'm done. I had to get out. Give me my bachelor's, I'm walking. So after being in the business for a while and being part of the broker dealer, I decided I wanted to go back for my master's. But I wanted they didn't have a master's that I was looking for. So I went to the Institute of Business and Finance and out in California, and under the recommendation of the broker dealer. And when I did that, they took all the information there. So they said, okay, fine. You're going to need to, do a couple of classes here and we'll get everything transferred over and we'll get you a master's. So that's how I had gotten the master's part. But as far as the rest of them, basically they're a certified annuity specialist, certified divorce specialist, certified fund specialist, certified income specialist, certified social security specialist, certified tax specialist. These are some, the BCA is a board certified annuity, board certified estate planner, board certified mutual funds. Those they don't have anymore. And then RFC is a registered financial consultant, but there were more. I dropped them off. But
Okay, that's quite a collection.
Well, yeah, and I do that in my spare time when I've got nothing to do.
Of course, like you would. Well, awesome. Well, let's dive into what something about you. I know you're a planner. Anything you want to show about your process, how you think about markets, how you marry active management with financial planning. I think you have some slides. If you want to dive into those, we certainly can.
Sure. I'm going to share my screen here.
You got it.
All right. I hope everybody can see my screen.
I can see it.
All right. We believe that financial planning is the key to success. And unfortunately, we are in an industry where financial planning, for the actual history of financial planning, when I first started 40 years ago, financial planning was only for the rich and famous, so to speak. It was expensive. We didn't have all the electronics we have nowadays, and we used to have to produce big books like you see that guy struggling with at the bottom down there. The problem with that was that somebody would come in and it would be a long, arduous process. But by the time you were done with the plan and you went through the plan with them, they take all this material, and you knew that they probably wouldn't read it again unless you were sitting down with them and going over it and doing a review. But just between the time that they carried it out of the office to their car out in the parking lot, there was things that needed to be updated. And I kept thinking about that. And I'm saying, this is just crazy. We need to find a better way to do this. So going back about a little over a dozen years ago, myself and it was about 500 planners across the country teamed up, and we got a hold of a IT company. And we said to them, here's what we're looking for. We were using 11 pieces of software to generate a financial plan. And we wouldn't get 2 updates in a year with 11 pieces of software. And I said, how could that possibly be? Things are updating almost every day. So the software vendor said to us, well, there's nothing we can do about it. So we decided to hire a company as a big group and said, we want you to come up with a plan that we only go one place and can do all these things and more that these 11 pieces of software can do. And it took them 4 years. Okay. But they did it. And I said, I wanted to do one other thing that we really couldn't do in the financial plan, and that was tax forward planning. And they said, well, what's your idea of tax forward planning? I said, every single day, I said, everything should be able to talk to each other, and we should be able to produce a 1040 form and have it run every single day so we can see ahead of time what's going on. And they said, okay, fine, we'll do it. So took them 4 years. They finally came out with it, and they gave us the beta program, and I said, here, you want to play with it? I said, no, I don't want to play with it. I gave it to our CPA. I said, take it and see if he can break it. And he had it for 2 weeks. He sends it back and he says, boy, this really does a lot of stuff. He said, I really like, he said, and it's accurate. If you put it in accurate, it's as accurate as anything that there is out there. I said, okay, fine. He ended up becoming a client when he saw what we were doing. Not only that, and trying to bring on a lot of his clients too. But the idea behind it was that, when we talk about, financial planning with people, the actual key to them, or the thing we bring up the most, is that if they can answer this question with a real true answer, then they might be well on their way. Because most of the people that walk into our office walk in with a spreadsheet and a brokerage statement. Okay. And they tell us that's their financial plan. And I just ask a simple question. Tell me how all your assets are ever going to be able to talk to each other and communicate to be able to produce the kind of income or the kind of quality of life that you're looking for in retirement for when you're going to need them. You can't do it. If you don't have the right type of plan put together, you can't do it. And with today's electronics and the way that we have everything set up, everything communicates with everything nowadays. So we go through the process and we show them, like in this case right here, there's 21 different asset categories just on this page. All right, that somebody could actually have things in there. And unfortunately, if you're just getting paper statements all the time and you're not in this kind of process, how does George's 401k plan talk to Sally's IRA, or Sally's 403b talk to George's investment account? Okay, they don't. Okay. And what I kept telling everybody was that no matter how much work you actually do in the plan, no matter how much buying and selling you do, and how much asset turnover or whatever you're going to do throughout your life, your report card is going to be your 1040 form. And it took a while, but people started to realize that, you know what, that's right. Because everybody kept saying, how do I make money but spend less money on taxes? So, and that's exactly what the planning does. So the first thing we do is we make it mandatory. We put together a plan for everybody, whether they want one or they don't. Okay. And then once they get involved and they see how much it actually allows them to have more full control over everything, they're on board, and there's never ever any kind of skepticism at that point. The second part of the plan is that once you have one together that is going to work on paper, you have to make it for real. So you have to fund it correctly. If you don't fund it correctly, it's just like going out and having an architect design a house for you and you never build it. Okay. It's just a piece of paper. So, and we all know what I said about paper. So we're trying to get rid of that. So the second part of the planning process is that we introduce active money management in to fund the plans. And that in itself kind of took a lot of people, I guess, by shock, because I live and work in an area down here where I am right next door to Vanguard and Fidelity and SEI, and I mean, they're my neighbors.
Yeah.
So everybody around here has been entrenched in their head with the knowledge that you can't time the market, you can't beat the market, you can't do all kinds of different things. And what I try to explain to them is it's not about trying to beat the market. What you're trying to do is you're trying to survive. And the whole time you're in the accumulation phase, you can go and make mistakes and you can get out of it because you've got time on your side and you're working. But when that stops and you go to turn on your income, you don't have that anymore. You make a mistake, it's going to hurt. So let's try and not make the mistakes, or try and fix it, or try and put something in it that's a buffer to a mistake, or give you enough information so you can steer around a pothole while you're driving down the street. So that's what we intended to do. And we added in active money management. So this is how I actually explain and give them some education. I use this chart. This chart is a Dow. It's a basic chart. Anybody can pull one of these up. And it goes from when the Dow started back in the early 1850s, not 1850s, 1880s, 1890s. They used to be called the rails. And basically, everybody that looks at this, I'll ask a simple question. What do you see when you see this chart? Well, everybody's eyes always go to the right-hand side and look how far up it went. Well, that's great. Let's go to the left. What do you see? Well, it just looks like it's just bumbling around on the bottom all the way through until a certain period of time. Then it seems like it takes off like a little rocket. Well, something triggered that. right? And something that actually was life-changing to all of us. Back in 1979 and 1980, the IRS, they relaxed the 401k codes that they had on the books. And basically what they did was they said to all the businesses out there that if we relax the codes and it doesn't cost you as much money to have these types of plans, basically, why would you want to have defined benefit pension plans anymore when you can have contributory pension plans? So what you're actually seeing is you're seeing the switch on the graph from people going from pension plans that were guaranteed to contributory plans where they're actually pumping money into the marketplace. Markets act like balloons. The more air you pump into a balloon, the bigger it gets. It's almost like an inflationary thing. And, I would see some frowns and some skepticism on some of the people in the class. And I would ask a question. All right, let me ask you this. What did IBM do in 1950, 1960, 1970, 1990, or 2000 to make their stock go from $10 a share to $100 a share, or whatever the price jump was? Are they that great of a company? Do they run that great of a company? What's the issue? And you would get a lot of feedback, and I'll say it's inflationary. And what they're actually doing is and inflation in the market is actually leverage. So I'll say to them, just follow along with me here. Let's ride this line a little bit. Let's go all the way up to 2000 here, where it peaked out, and we see the first drop down. We all know what happened. 1990s, they were great for the marketplace. Went all the way up when we had a tech bubble that popped. But we also had a bunch of other things that happened in those 3 years that the market went down. We had 9/11. We had a couple other things that happened, okay, that were big. And then when we get down to 2003, when that ended, the government said, well, wait a minute. We need to boost the marketplace back up. How are we going to do this? I don't know whether they did it behind closed doors, somebody had a dream, or whatever they did, but they decided that everybody should be able to own a house, whether they can afford one or not.
Yep.
So what they did was they came out with Freddie Mac and a bunch of the other acronyms that they had for mortgage companies, and Sally Mae and all those other kinds of things.
Mm-hmm.
And they said, so what we're going to do is we're going to allow everybody to go out and go buy a house, and we're going to help you fund it, finance it, down payments, the whole 9 yards, and you can even borrow up to 130% of the money to get into a house. Okay. We just want you to get into the house.
Right.
And that's exactly what happened until we get to the end of 2007. 2007, what happened? Basically, the bill came due.
Yeah.
Okay. And we saw it. I mean, we saw it with, different, Lehman Brothers and a bunch of others. I mean, that were holding bonds, and they said, well, we'll take these things and we'll give them to the marketplace. They'll know what to do with them. Sure. They leveraged them out 30 times is what they did. Okay. And that was great when they were selling them. But as soon as somebody wanted to collect on one, they had to come up with the money. And I mean, they even make movies about this stuff.
Yep.
It's unbelievable. So we all know what happened at that point. And then in 2008 came, and what happened? We had a down market. We had a down market that went all the way down to actually 2009. And where it actually hit the bottom was on March 9th of 2009. Now, what I normally like this chart for one reason, because it starts to show a pattern that's developing here, that the first major correction that we really saw lasted 3 years. The next one lasted a year and a half. So what happens when you leverage is you either get more frequency, more severity, and shorter time frames. Okay.
Right.
And that's what we're starting to see. All right. Now, to get out of this one, basically, the government said this was a doozy. We got to do a few things here. So the first thing they did was, I remember I was in Dallas at that point, and I was down there for a meeting. And I remember on a Friday afternoon, they decided that they were going to bump up the FDIC insurance because they were afraid of the banks. And when they did that, anybody that had a money market fund that it was holding short-term government certificates in it, okay, or short-term government bonds, got dinged overnight between 2 to 3%. Okay? And it was funny because, I mean, like, I remember the Vanguard money market fund. People had held that. Oh, listen, that's guaranteed. It's not guaranteed. It's a mutual fund. And
Right.
on Monday, when they woke up, they were down 2.5%, 3%. Like, what happened to the money? Somebody has to pay for the FDIC insurance.
Yep.
So not only that, they decided to come up with TARP funds, because there were obviously companies out there that were too big to fail, and the government wasn't going to let them, go under. And TARP funds originally was supposed to be a loan to the companies, and nobody was really supposed to make money on the deal. But what the government did is they did something really nice. They used our money and they loaned it to the companies. They took portions of their common stock for collateral in doing it.
Mhm.
They held the common stock until the stock went up. They sold out the stock at a profit, okay, on most of them. Now, I mean, it's companies like AIG, a lot of pharmaceutical companies, a lot of the auto carriers, okay, with the only one I know that I really know of that didn't do it was Ford. But
Mhm.
if you think about it, when they sold out and they made a profit, and some of them made huge profits, because I remember in a couple of those weeks, I remember buying stocks for $2 and at the end of the week on Monday, and at the end of the week selling them for $4 and $5 a share.
Mhm.
Okay, that's a huge profit.
Yeah.
My question I always ask people is, did anybody here get a dividend check back? Or did you get any kind of refund because they used our money to borrow to give to them? They made a profit. Did we get any of it? I didn't get any.
Right.
So anyway, not only was that an issue, but they figured that they have to shore up the marketplace now. Okay. So in doing that, they had to come up with something called quantitative easing, where they're
Mhm.
going to print money, they're going to pump it into the market so that the market isn't going to go bankrupt. Okay. So they did that, and it worked so well the first time, they decided to do it two more times. So we had QE1, QE2, and
Mhm.
QE3. QE3 ended on December 31st of 2013. But that still wasn't enough, and they knew it wasn't going to be enough. They needed all of our help to be able to get out of this mess. So they also knew that if they sent their agents knocking on our doors, okay, and you get that old fable knock on the door and the guy standing there saying, listen, we sold war bonds before and we did all kinds of different things. Would you like to loan the government money to help us get out of the mess that we created? And they knew what the answer was going to be. Nobody would want to do it. They would probably say to them, like I would, you created it, you get yourself out of it.
Yep.
So they did it underhandedly. They said, we can do this, but we don't even have to get their approval to do it. They lowered interest rates all the way down to dirt because
Mhm.
everybody that had safe money sitting in the banks that they just raised the FDIC insurance for, they said, we need to get them to move that money out of there and put it into the marketplace so it can help us shore up the markets. So what happened? CDs that were earning anywhere from 5 to 7% were renewing at under 1%. That's a heck of a shock when you get one of them.
Oh yeah.
So you had a lot of people that were, a lot of elderly people that had safe money that were using that money for income. All of a sudden, they have to start chasing yield now. The government knew that they would do it. So they moved the money from the banks over to the marketplace. Now, that in itself wasn't a bad deal because the marketplace went up, their money went up, and it otherwise may have not gone up. Okay, in most circumstances. What they didn't realize, and what we try to point out to them, is when they look at this chart and you keep looking about how it still went up over here, I asked them one other question. Before, when you had 50% of your money in the marketplace and 50% of your money in the bank that was guaranteed, now where's all your money? Now it's like 95% in the marketplace.
Mhm.
And the only money they have in the bank is the money that they use to pay bills with.
Right.
So what they did was they made money, but they added on to their additional risk exposures. So when we start to explain to them about how would you like to be able to participate in the marketplaces in a scenario where when things are going good, you add fuel to the fire and let it go up. And when things go bad, you have some kind of buffers or some protections where you can either sit on the side in cash or
Mhm.
maybe do some other things to help protect you.
Right.
Well, that's great. We only heard about it in theory. Does it actually work? Well, yes, it does.
Right.
And there are things that we get into later on.
Sure.
I'm not going to actually get into all those things right here because we're in a short program. But
Yep.
one of the things that I did here was I zoomed in from here from 2000 all the way till today. Okay. And I
Right.
bring this to your attention because we talked about that frequency
Mhm.
on corrections and things like that. We see corrections that are happening more and more often. Okay. They're being more violent, faster, but not lasting as long. We're also seeing a market. Now, the Dow's at 42,000 today. All right. Now, think about that. It started all the way down here. It's at 42,000. The reason I picked the Dows because that's the thing you state that you see everybody normally sees all night long. Even when the news or the news people show it, they show the Dow because everybody
Right.
knows it. But if you looked at the S&P, you looked at the Nasdaq, they follow suit. So my question is this: as of today,
Yep.
we were 35,675,000,000,000 in debt. That was as of 2 o'clock this afternoon. Now, with that being said, and you're looking at that money, that Dow's going up, what do we think's going to happen? There's going to be a day of reckoning coming here pretty soon, right? The scary part is not the U.S. debt. The scary part is down the bottom down here, where the U.S. debt to GDP ratio back in 1980 was 34.68%. Today, it's 124.32%.
Yeah.
Okay. So everything is leveraged out big time. Now, to add insult to injury about this, everybody watches the news. What did we just see? We just saw what happened with the FEMA funds. Okay. And the people from, Hurricane Helene.
Yeah.
Okay. They're looking for money. FEMA says, we don't have any money to give you. What'd you do with it? Well, we used it for the migrants. And now they're saying it was part of a whole different fund. And I'm not going to get into the politics of it. I don't care which fund it was. They need money. We need to give it to them.
Right.
So, and they're going to get it. And we all know how they're going to get it. They're going to pull out the printing press again.
Of course.
It's exactly what they're going to do. So, I mean, bottom line is that if you don't plan for yourself and you don't help yourself, we can't expect the government to help us. Okay. It's number one. So we got to take control. Number two is, if this is the game that we have to play, we need to know what all the rules are. And we need to be able to know how to tactically maneuver through this thing, because it's about survival anymore. So,
right.
basically, that's our story, and that's what we're sticking to.
Nice. Well, we have a couple of minutes. Is there any high level things you could talk about? Like, how do you approach protecting money in these bad markets? Do you use inverse funds? You just get out, go to money markets? What kind of strategy do you use to protect money in these bad environments?
Depends on the risk profile of the person that we're actually talking about, but we have 5 basic models, and then I have 3 alternate models.
Mm-hmm.
All right, the 5 basic models are similar to your split of stocks versus bonds. Okay, sure. Between conservative all the way up to growth. And in those, mostly what will happen is, like, for example, like this year, we sold out one time. I was actually going to change the equities anyway, but we had there was a kaflooey in August, where I came in here on a Monday morning and everything was going crazy and the markets were flying all over the place. So what I did was I just swapped out the equity side of it, left the bonds. Okay, that was in there. I am not opposed to going to cash. I'm not opposed to holding cash, and I'm not opposed to using inverse if need be. But we have to be pretty careful about that, because you've got regulators now that really don't like inverse. They don't like inverse ETFs for whatever reason. So we have to be pretty careful on that. And most of the people that we have in programs that we're using any kind of alternates like that are accredited investors.
Wow.
Yeah.
Even if it's just for hedging.
Even if it's different, even if it's just for hedging, because what happens is we've already been in situations where we've gotten audited, and they came in and they're actually looking for them. Okay, they knew ahead of time what they were looking for no other reason other than just because they were doing it to everybody.
Right.
And they come in and they get you agitated and everything else, and you look at that and you say, who needs this aggravation? Nobody needs it. So, and the strategies that we use were actually designed by me, for my money. And what I did was, when I left the broker dealer and I brought clients with me, I basically, since I started those strategies, I invest in everything I ask my clients to invest in.
Absolutely.
So,
no, as you should. Well, nice. Now we're getting up to time. I think you have is there an investment quote you like to share? Favorite of yours?
I do. It's this one right here. Yes. People don't plan to fail. They fail to plan. It's unfortunate, but we've seen it all. But the people that do plan, the people that will take the time to plan, they get the success ratio of them is so much higher that I can't imagine why anybody wouldn't want to plan. The one big question that I always get is, when's a good time to start planning? And there is no good time to start planning. It's as soon as possible.
Right.
You might not have all the assets to be able to rearrange, to do things, to fund a plan correctly, but planning is not always just about rearranging things. It's about education, and it's about knowing how to get the information so you can make the decisions as they come up.
Right. No, awesome wisdom. And then, of course, your contact information is down there at the bottom, so somebody can get in contact with you if they want to further the discussion. And then, of course, NAAIM has the NAAIM Outlook Conference coming up October 28th and 29th. Are you going to be there?
I am.
Awesome. I will be there too. We'll definitely catch up in person. I'd love to continue this conversation. Some great information, great insights. A little different than what I've heard, so I appreciate the insights, and thanks for being here today.
Well, I appreciate you inviting me. Thank you.
Well, absolutely. Well, we'll see you in Dallas, and thanks everybody for being here today, and we'll see you next week. All right.
All righty. Thank you.
Thanks, Chuck.
Take care.